contango is nothing but the normal market. So under normal market, your futures price is always higher than the spot price. So a contango is nothing but a normal market, whereas backwardation is nothing but a inverted market. So you can remember backward with inversion, where your futures price is less than the spot price. Now there are three sources of return on a commodity futures contract. So the first source of return is nothing but the roll yield. The second source of return is the collateral yield, and the third source of return is nothing but the change in the spot price. So basically, rolled yield, if I were to define, it is nothing but the return or the P&L or the profit or loss which I am making as futures price converges to the spot price. Finally, on the maturity of the contract, both the futures price and spot price have to converge. If they don't converge, then the contract is not completely in line with what we have expected. So if they don't converge, then something will result which is referred to as basis risk. So if I were to look at a contango market, so if this is my spot price on expiration, so in contango market your futures price will be approaching the spot because futures will be greater than the spot at the beginning. So that will be approaching the spot as one approaches the maturity. This means that one is going to generate a negative yield, which means that the roll yield for contango market will be negative. Please remember this, that roll yield is always negative for contango market. Don't get confused that since F0 is greater than S0 or the futures price is greater than the spot price, the yield is positive. It is the other way around for backwardation markets. So in backwardation markets, your futures price is converging to the spot from below, which means the yield is going to be positive. Now the next yield is the collateral yield, which is nothing but if we are going to place some treasury bonds or some other bonds as collateral for a commodity futures trade, then the yield which we will get on the treasury bond will be called as the collateral yield. And the third source of return is the change in the spot price. So in case there is some change in the spot price, I will also get a return. So if one was to price a commodity contract, always in commodity contracts you have got something called as the storage cost, because commodity contracts are subject to storage of the commodities. And the second what we have is the convenience yield. So effectively my futures price will be nothing but the spot price plus the spot price into the risk-free interest rate, which is nothing but my normal yield, plus the storage cost. You always keep on adding the cost. It should not happen that you subtract the cost. Always the costs are added while deriving the futures price, and incomes are subtracted while deriving the futures price. And since if I was to consider only these two things, then my futures price would have been less than or equal to these two terms. So to make them equal, I subtract a term which is referred to as the convenience yield. Now the next type of alternative investments which I want to refer to is the private equity investments. So when we are referring to private equity investments, we will be looking at leverage buyouts. So in leverage buyouts, you are purchasing the cash flow or purchasing another company and you are taking debt to purchase that company. However, the cash flow of that company will be used to service the debt. So if I am looking to purchase a company A using a debt, then my underlying is that once I purchase this company, the underlying cash flow will be used to service this debt. So this is called a leverage buyout. The next you have got is the venture capital. So venture capital has got three stages. You have got the formative stage. So the first stage would be where one is looking to invest in a company which is just in the startup phase. So if I were to look at a company which has just started its operation, probably it has not even started its sales, then it will be a part of the formative stage. Then I would want to come upon to the other stages also. So basically when I am looking at venture capitalists, so there are other ways of investing in the venture capital investment or in the venture capital company. So that can be done by means of taking mezzanine positions, or which is nothing but a combination. Mezzanine means that it's nothing but a combination of debt and equity. So when I'm investing or when I'm taking a mezzanine position, That means that my investment is a combination of both debt and equity, which means that I will also be absorbing certain part of the losses along with having a equity nature. So this is more to do with private equity. Now before I move on to another kind of investment, which is nothing but the real estate investment trust, I think one must be very aware that in alternative investments, much of the questions are more to do with the theory part or to do with the conceptual part. Only sums will be tested on valuation of real estate investments. So you could have a question which would be testing you on the net operating income. So in the question you may be asked to compute the net operating income. Apart from that, I don't see much of quantitative stuff coming in for alternative investments. It will be more of theory and less of quant stuff. Now let me now look at exchange, or let me look at hedge funds. So we have already covered what are hedge funds. So now I will just want to shift to valuation of real estate investments. So in valuation of real estate investments, there are three methods. One is the cost method, the second is the sales comparison method, and the third is the income method. So one must remember all the three. Now the income method uses a discounted cash flow model similar to that of a perpetuity. So if you would have seen the formula for perpetuity, let me come to it. So you have got the cost method, sales comparison method, and the income method. So if I'm using the income method, then my value of the investment would be the net operating income divided by the market cap rate. So market cap rate is nothing but the market capitalization rate or the rate of discounting. Now how do I compute the net operating income? So my net operating income, if I've been provided by, let's say, 4 or 5 different things, I've been given the rental income, I've been given the vacancy rate, which is nothing but for how many percent of times it remains vacant. I've been given the insurance cost, taxes, the utility bills, and the maintenance. Now if I were to compute what is the net operating income, it is nothing but the rental income into 1 minus the vacancy rate, which means the actual rental income realized, minus the insurance, minus taxes, minus utilities, minus maintenance cost, and also if there are some other expenses, I have to subtract it to arrive at the net operating income. Once I have got to the net operating income, the next step is to divide it by the market capitalization rate to compute the value of the property. So effectively, net operating income is nothing but gross operating income less the estimated expenses. Now finally, I would now want to move to the exchange traded funds, which are nothing but referred to as ETFs. So they are also a kind of alternative investment tool. So a person who is not willing to take direct exposure to the equity markets, he may prefer to go to an ETF market. So in ETF markets, either the ETF could be consisting of a portfolio of stocks or bonds, and it is designed to replicate the performance of a specified index. So if I'm referring to a ETF for the Nifty, that means that the performance of the ETF will be replicating the performance of the Nifty. Now one must clearly remember what are the advantages and disadvantages of ETFs. So specifically, if I were to look at the advantages, basically ETFs result in diversification, and I'm trading something which is similar to trading in equity. However, I'm not taking the same amount of risk. So because I'm not taking the same amount of risk, the risk management is better in case of ETFs. The exact composition of the portfolio is always known at any point of time, because it is going to be the same at any point of time, and they are very much efficient in terms of the expense ratios. There is no load to purchase or redeem the shares, and there is a decreased capital gains tax liability. So this is something which is a disadvantage of mutual funds. So I'll also come to what are mutual funds. So these disadvantages are taken care by investing in ETFs. However, there is some sort of disadvantage also involved by investing in ETF. So one must be very much aware as to ETFs have low trading volumes, which will result in large amount of bid-ask spread, and large investors will never want to invest via ETF. They will want to directly invest in the shares because that will result in a lower expense or a lower tax consequence to them. And so we have, with this I have covered hedge funds, I have covered what is valuation of real estate, I have covered what is commodity futures or investment in commodities, we have covered valuation of real estate, okay, I have covered ETFs, and finally I would want to cover mutual funds. So basically mutual funds are nothing but they can be further classified into different forms. So either it could be an open-ended fund or it could be a close-ended fund. So if it is a open-ended fund, that means that I can purchase or sell the units or what I refer to as the NAVs in the secondary market. However, if it is not a open-ended fund, if it is a close-ended fund, then the only way I can do is that the corpus will remain fixed, and again the units can be traded on exchanges. So basically in an open-ended fund the corpus is keeping on changing, whereas in a close-ended fund the corpus remains fixed. Now if I were to see what is the NAV, NAV will always be the difference between the value of the fund assets minus the fund liabilities. Now generally open-ended funds, the redemption usually takes place at the NAV, whereas in case of close-ended fund the redemption may take place at a premium or a discount to the actual NAV because they are traded on exchanges. Now what are the type of fees which one sees in a mutual fund? So there are something called as load charges. Load charges can be either a front-end load or a back-end load. So one must be aware as to when we go to purchase a mutual fund investment, there is a charge which is taken from us which is called as the front-end load, and at the same time if I wanted to redeem or sell the investment in the secondary market, again I will have to give a, I should say, a part of the investment which is referred to as the back-end load charge. Now one must remember when I am referring to mutual funds, what are the type of funds? So mutual funds are classified as style funds, sector based funds, index based funds, international exposure based funds, global exposure based funds, stable value funds, and guaranteed funds. So I would want to just touch upon this. So mutual funds further classified as style funds. So basically style fund could be either a value fund or a growth fund, or it could be something like a large cap fund or a mid cap fund. So this is something which we commonly see in the market. Then I could have a sector focused fund. So I could have a banking focus fund which is created. Then I could have a fund which is tracking a particular index. So it could be tracking either S&P 500, or it could be tracking FTSE, or it could be tracking Nifty. Similarly, I could have a fund which is a stable value fund, which means I am going to make use of government securities. Similarly, I could have a guaranteed return fund, which means that it is going to guarantee a specific rate of return to me. So one must be very much aware as to what are the different kind of funds. So with this, I have tried to just touch upon what are the different points which one must look at while revising alternative investments. Probably it is not possible to get into all the details in such a short tenor. So basically with this, I would want to move to this next section. Now one of the points, or the couple of points which one must remember, that commodity index strategy, that is nothing but a commodity future strategy, is not a passive strategy like the way it is for equity funds. So commodity index strategy is an active strategy, and there have been questions which I have tested on which are active strategies and which are passive strategies. So one must clearly remember that commodity strategies are active strategies. Now the reason they are active is that you need to continuously rebalance the position in terms of what has to be taken in terms of the futures position and what has to be reinvested in the collateral. Now, the hedge fund reporting biases, which we have already discussed, must be read in detail because they have been tested a number of times in the CFA Level 1 exam. Now, the next thing is one must also remember the difference between a mutual fund and an exchange traded fund. One must remember what are the advantages and disadvantages of a mutual fund and how they are eliminated by exchange traded fund. However, at the same time, an ETF also results in some disadvantages, so that must be remembered. Now, in case of net operating income, okay, one must only consider the property taxes. So if I were to look at the expenses while computing the NOI, I must only take into consideration the property tax and not the entire tax that the investor is paying, because I am only concerned with the tax which an investor is bearing for a particular property. So I think with this, I've tried to cover most of the things in alternative investments. Now, next section what I want to look at is portfolio management. So probably I'm just going a bit in a different manner compared to what is given in the slides, but I'm touching upon each and every topic one by one. So in case of portfolio management, please remember what are the important parts of the IPS. IPS is nothing but the investment policy statement. So there could be questions which could test you as to what is a part of an IPS and what is not. So one must remember that the IPS consists of the investment objectives. So the investment objectives could be in terms of what is the risk tolerance level, what are the return objectives. So it could be the risk levels which one wants to bear or the return objectives which one is ready to see for a particular investment. So return objectives could be purely in terms of what is the current income, in terms of dividends. So there could be a demand by the investor that he is looking at a annualized yield of, let's say, 5% or 6%, which means that he is looking at a continuous dividend yield of 5 to 6%. Or it could be that the investor is not looking at a dividend yield, he is more concerned on the growth, which means he is more focusing on the capital appreciation. So basically, the current income plus the capital appreciation will form what is called as the total return. Now, the constraints which one must look at while formulating the investment policy statement is the following. One must take into consideration the time horizon of the investment, the liquidity risk which exists with a particular investment, because all the investments do not have the same kind of liquidity. Some investments may be liquid in nature, some may be highly illiquid in nature, so that must be taken into account. One must also take into account the taxes which are levied upon the dividend or on the capital appreciation. So in case the taxes are not in line, if the capital gains tax is much higher than the dividend yield tax, then as a portfolio manager, you may advise your client to go for a high current income based strategy, because you will be levied less tax compared to going for a growth strategy. Next, one must also look at the legal factors which are more to do with the meeting the norms of a particular country. So if it is for India, then one must understand what are the norms of SEBI or what are the conditions which SEBI imposes for different funds. And then one must also take into account the unique needs and preferences of an investor, which is more of a constraint because each investor will have a unique need and a unique preference. So basically, risk can be classified into two parts. One is the willingness to take the risk and the second is the ability. So a high willingness to take risk with a high ability to take risk refers to a high risk tolerance, whereas a low willingness to take risk combined by a low ability to take risk is nothing but a low risk tolerance. Now these are something which are in sync. What I'm more concerned with is that if my willingness to take risk is low, however my ability to take risk is high, that means that I'm just wanting to take a bet or I'm just wanting to speculate things. So in such a case, education is required. Similarly, for the other way around, we need to educate the investors because that may result in a large loss to their portfolio positions. So basically, if I were to look at what are the different type of clients which I could have. So we could have a mutual fund, I could have a exchange traded fund. Similarly, I could have a mutual fund versus a hedge fund. Similarly, I could have a mutual fund versus a venture capital fund. So basically each of these investments or each of these funds has a different risk versus return strategy. So basically if I were to refer to a hedge fund, their risk tolerance level is very high because they are also expecting a very high return. On the other hand, if I were to look at a mutual fund, their risk tolerance level will be comparatively low because generally such funds do not take high risk because the returns also assured to the investors are on the lower side. At the same time, some of the mutual funds may be guaranteeing you some returns, which means that you cannot take highly risky positions because it may result in a loss to the portfolio. So basically, whenever I'm coming to the portfolio management theory, I must remember the Markowitz equation. So Markowitz equation is nothing but the return on a portfolio is nothing but a weighted average return of the different assets. So it is E of Rp will be nothing but W1 times E of R1 plus W2 times E of R2, where the weight or the sum of the weights is always equal to 1. Now in this case, if I were to calculate the standard deviation or the variance, if I'm again making use of the population data, in the denominator I will use T. If I'm making use of the sample data or if I'm computing the sample standard deviation, I'll make use of T minus 1. So this is in line with what we had discussed yesterday when I referred to making use of different formulae for the population standard deviation and the sample standard deviation. Now before I move on, if I wanted to compute the variance using the Markowitz formula, it will be the same formula which I used yesterday. So sigma p square will be equal to W1 square times sigma 1 square plus W2 square times sigma 2 square plus 2 times rho into W1 into W2 into sigma 1 into sigma 2. So this is when sigma 1 and sigma 2 have been provided in percentage terms. My final portfolio sigma will also turn out to be in percentage terms. So this is for a 2 asset portfolio. I can extend the same argument for a n asset portfolio. Now within this standard deviation term, I had referred to a term called as the correlation coefficient. So if I were to compute the correlation coefficient between two assets, then it is nothing but the covariance of xy divided by sigma x into sigma y. So if I were to just revise this, covariance of xy is nothing but E of xy minus E of x into E of y divided by sigma x into sigma y. This is nothing but the same thing as what is written in the numerator here. Please be sure as to the different formulae which are being used because this is something which will be tested commonly for portfolio management, be it quants or be it even some part of fixed income. So basically, if one of the assets in a portfolio is a risk-free asset, which means that if I am trying to construct the capital market line, then for a risk-free asset, just remember that the return will be equal to RF. Okay, so I am referring to the risk-free asset as A. This will be equal to constant return RF, whereas sigma for that return or that for that risk-free asset will always be equal to 0. That is the reason you are calling it as a risk-free asset. So basically based on this, I have tried to refer to what is the capital market line and what is the SML, which is the securities market line. So one must be very clear as to a capital market line is nothing but a line which is tangential to the efficient frontier portfolio. If a line is not tangential to the efficient frontier portfolio or the market portfolio, then it's not called the capital market line. It is called as a capital allocation line. So if I were to construct a similar line which would be passing from inside, this is not an efficient frontier. Why? Because it is not tangential to the portfolio or the risky portfolio. Such a line will be called as a capital allocation line. Only one line will be tangential to this market portfolio, which is the most efficient portfolio, and this is called the capital market line. Now in this case, the efficient frontier is nothing but this straight line. Now from the point which is nothing but the y-axis till the market portfolio, I am going for a positive amount of both the risky asset and the risk-free asset. So that means sum of this will be equal to 1 and both the assets will be in a positive proportion. If I go beyond the market portfolio, that means that I am going to make use of leverage, which is nothing but I am going to borrow risk-free asset, which means that the weight of the risk-free asset will be negative, whereas the weight of the risky portfolio will be greater than 1, such that the sum of these two will be equal to 1. So this is nothing but which I call as leverage. Second thing which I must remember is that in capital market line, the x-axis is always the portfolio standard deviation. If I were to move to the SML, on the y-axis again I've got the return, but on the x-axis I've got something which is called as a systematic risk. So in case of securities market line, I'm assuming that the portfolio is completely diversified. Only if the portfolio is completely diversified, I can make use of systematic risk as a measure to see the overall risk of a portfolio, because the specified risk of the asset will be completely eliminated when I'm diversifying the portfolio. Now, just one tricky question or one tricky point is that CML is always used to price efficient portfolios. Now in this case, efficient does not necessarily mean diversified, whereas SML, which is nothing but the security market line, can be used to price both efficient and inefficient portfolios. So, which means in this case I'm not referring to efficiency as diversification. Now this is something which you must just keep in mind, that CML will always be used to price efficient portfolios, whereas SML can be used for both. Now if an asset has to be correctly valued, then it must lie on this SML. If it is above this or if it is below this, then the asset is either undervalued or it is overvalued. Now in portfolio management, most of the questions which will test you in terms of the quantitative examples will be based on the Sharpe ratio, the Trenor ratio, the Jensen's alpha, and the M squared return. So basically you must remember all the four. Now the Sharpe ratio is nothing but, I would just want to rewrite this formula because I think the formula has not been written correctly. The Sharpe ratio is Rp minus Rf upon sigma p. So this is not required because sigma of f is always equal to 0. For risk-free asset, I never have any standard deviation. So this will converge to this. So this is the formula which is usually given in Schweser or in most of the books. Similarly, for Trenor ratio, I have got Rp minus Rf upon beta p, because beta f will again be equal to 0 for a risk-free asset. It has no dependency on the market portfolio, which means beta is 0. So basically, what is the difference between the Sharpe ratio and the Trenor ratio? It is the denominator. In Sharpe ratio, I am making use of the total portfolio standard deviation in the denominator, whereas in Trenor ratio, I am just making use of the beta or the systematic risk. Similarly, Jensen's alpha, I am just trying to compare what is the actual return I have got compared to the return using the CAPM model. So CAPM model is nothing but E of Rp equals Rf plus beta times E of Rm minus Rf. So this is nothing but the SML equation. If I am able to generate a return which is greater than the SML, then that is nothing but my Jensen's alpha. And similarly, I have got the M squared return. Please try to remember all these four formulae because there will be questions which will be testing you on this. And there could be some playing around between the different ratios. So you could have been given the Trenor ratio, and based on the Trenor ratio, you may be asked to calculate the Sharpe ratio with some additional information, or you may be given the Trenor ratio and you may be asked to calculate the Jensen's alpha using some additional information. So please keep a note of all this formula and try to derive or try to establish a relationship between each of them. Now, the market risk premium is always E of Rm minus Rf. It is not equal to beta times E of Rm minus Rf. So this is where most of the students tend to make a mistake. They assume the market risk premium to be beta times E of RM minus RF. It is not the case. It is only the difference between the market return and the risk-free rate. Now, if I wanted to decide as to which fund is performing better, then the result which is derived using the M squared measure and the Sharpe ratio has to be the same, which means that if M squared return suggests that fund A is performing better compared to fund B, then Sharpe ratio must also suggest the same. If that is not the case, then I have made some mistake while doing the computations. Similarly, if I were to use the Jensen's alpha and the Trenor ratio, then both these results must give me the same fund, which is, let's say if Jensen's alpha says that fund A is better compared to fund B, then Trenor ratio should also suggest the same. If they again suggest two different things or contradicting things, that means the calculations have been done incorrectly. So basically, Jensen's alpha and Trenor ratio are in one group, whereas Sharpe ratio and M squared returns are in another group. Now, one more thing, that investors will never be compensated for bearing the unsystematic risk or the specific risk, because basically they can be diversified away, and if you are not able to diversify away, that means that there is a problem in your portfolio composition. So investors will only be compensated for the systematic risk. So I think with this I have tried to cover the entire crux of what all forms a part of portfolio management. So basically, please be very sure about the formula, because in portfolio management there will be questions which will be testing you on all the formulae. Now just I want to touch upon quickly on derivatives. So please understand the difference between forwards and futures and what are the advantages and disadvantages of each of them. I think I can just move on. Please remember the formulae for the forward rate agreement. So in case of forward rate agreement, we are just fixing the interest rate for a future date or for a future period. Now if there is an FRA which is 3x6, now there is a confusion which students tend to make. A FRA of 3x6 means that there is going to be a forward rate agreement which will start after 3 months and it will exist till 6 months. So for this tenor, I am fixing the interest rate. It is not the other way around, where I am saying that it will start at 3 months and it will go on for 6 months, which means it will end at 9 months. So tenor of a forward rate agreement will be the difference between these two terms. So in this case, it will not be 3x9, it will be 3x6. So this is a 3x9 FRA, this is a 3x6 FRA. I think I am clear as to what does a FRA mean, and please remember the payment which is done at settlement for the long leg. Now one more thing which you must remember is how to value an interest rate swap, and please remember that valuation of or value of an interest rate swap at the beginning is always 0. So there is no exchange of any MTM or any money between the two counterparties at the beginning of the contract. Only after the time has passed, either one party will be in the money, that is he will be making profits, and the other party will be out of the money by the same amount. That means this is a zero sum contract. That is, the profit to one party will be the same as the loss to the other party. Now let me come to derivatives. Please remember the lower and the upper bounds of options. So there is a trick to remember this. If I am using a call option, then the minimum value is going to be maximum of 0, st minus x divided by 1 plus r raised to t. It is going to be the same for an American call option. The maximum value for both these options is going to be the stock price. However, for European and American puts, the minimum value and the maximum value differ. So please be aware with this. Now the next thing which one must remember is the put call parity. So put call parity is nothing but the put price plus the stock price should be equal to the call price plus the discounted value of the strike. Now in case there is a dividend which is being paid, effectively dividend is nothing but an income, which means I should adjust my stock price by the dividend, and income is always subtracted while looking at the put call parity or while deriving the futures price. So costs are always added, income is always subtracted. Now a buyer of call option is not the same as a seller of put option. Please remember that a buyer of a call option has the right, whereas a seller of put option is obliged to fulfill the contract. So buying of a call is not equal to selling of a put. Similarly, buying of a put is not the same as selling of a call. Now in FRA, if I were to look at the payment of the long leg, so if I were to come to this formula, the payment to the long leg at settlement is nothing but the notional into the floating leg minus the fixed rate which I have fixed for the tenor into the number of days of the contract. Typically FRA is for a 90-day period divided by 360. So in this case it is always 360 and it is not 365. Most of the time students tend to make a mistake that it is 365. It is not the case. The next thing which one must remember, that this payment is settled upfront. So that means that it is not settled at the end of the tenor, it is settled at the beginning of the tenor. So this must be discounted during the tenor. So I will be discounting this using the floating rate and not using the forward rate. So please make a note of this. It is not the forward rate, it is the actual floating rate which I am using to discount this cash flow. Basically, when I am referring to derivatives, just remember what is the difference between futures and forwards, what are the advantages and disadvantages of the same. When I am referring to futures, please understand the advantages of a clearing house, what is the meaning of initial margin, the maintenance margin and the variation margin. At the same time, also remember the different kind of option payoffs. So what is the call option, what is the put option. If I am referring to interest rate derivatives, I would expect you to understand the valuation of a fixed to floating swap and a floating to fixed swap. At the same time, I would also want you to understand the valuation of a FRA. So fixed to floating swap, by definition it means that I am going to pay fixed, I am going to receive floating. Floating to fixed swap, that means I am going to pay floating and going to receive fixed. Typically swaps can be valued by breaking it into two different bonds. So I am going to be long on one of the bonds, which could be either the fixed rate bond or the floating rate bond, and I will be short on the other bond. So the valuation of swaps is typically done by breaking it into two different bonds. I think with this I would now want to go on to the questions part. So probably I would want you all to post questions. So first question I want to take upon is, what is the difference between the capital allocation line and the capital market line? Basically, if I were to just look at the capital market line, it is nothing but the line from the risk-free rate which is tangential to the market portfolio. However, there could be multiple lines which I could have drawn from the risk-free rate. Some would have intersected the market portfolio, some would have gone above the market portfolio. So all such lines or all possible lines which I can draw from the risk-free rate is referred to as the capital allocation line. However, the capital market line is a single line which is tangential to the market portfolio, which means that this is the line which represents my efficient frontier. Okay, now the next question is to do with what are vulture capitalists. So something similar to venture capital fund. I've got a vulture capital fund. So basically they are, in simple words if I were to put it, basically they take stakes in small startups in the initial phases and they actually grow the startup, make it profitable and then exit out. So probably they exit the fund once they have made sufficient profits. Now, before I move on to the next question, I would want you all to just be very clear about different alternative investment asset classes. The reason I'm stressing on this is that the number of questions which will be appearing for alternative investments and derivatives will be very less in number, so it could be typically be somewhere between 3 to 4 for each of them, because the weightage for each of them is very low. However, it is expected that you have to get at least 50% of the questions correct, because generally the marking scheme is that there is an individual cutoff for each of the sections, which means that you would get at least 50 percentile for each of these sections. So please do the questions very carefully, because you don't have much of the questions to solve. On the other hand, if we are looking at FSA, that is, or if we were to look at fixed income, I would have sufficient number of questions so that I can make some number of errors. That is not something which I can tell you that you are allowed to make with alternative investments and derivatives. The next question is, are ETFs securitized? Especially when I'm referring to this from a CFA level viewpoint, level 1 viewpoint, you need not look at securitized ETFs. In reality, you will find securitized ETFs which are present. However, we will not be requiring this from L1 viewpoint. So, what is angel investing? That is the next question I want to look at. So typically, if I want to start a business, I will need some funds. So the first resort of funds would be my family members, that is my immediate family members. I could then go to my friends, I could go to my relatives. But even after all this, if I'm not getting sufficient capital, then I could go to a third party fund, which is referred to as the angel fund. So he acts like an angel to me, because after giving that fund, I can run my business. However, there is a big disadvantage involved, because if I were to take capital from him, I have to give him a high amount of return, because angel investors are only bothered about their own interests. They are not interested in actually developing the business. So basically, they are only concerned as to how much return they are going to make on that investment, rather than actually worrying about you. So generally, angel investing is not a preferred way of taking capital, but it's only a way in case you don't have any other option. Okay, market risk premium. So what is market risk premium? That is nothing but the return between what you can expect from the market for taking a certain amount of risk and what you can expect from a risk-free security. So the market risk premium will be difference between the expected return on the market and the risk-free rate. Now, what is a mistake that most of the students make is that they assume that the market risk premium is equal to beta times E of RM minus RF. That is not the case. So market risk premium is just nothing but just the difference between market return and the risk-free rate. Okay, next I would want to touch upon is, I don't think we are having sufficient questions today. So basically, I just want you to focus on 2-3 things. Once again, I would want to say that derivatives and alternative investments are 2 sections where the number of questions which are tested are not many. So that means that you have to do these 2 sections very carefully. You cannot afford to make mistakes in these 2 sections. At the same time, I would say that alternative investments is a topic where you may not have come across most of the terms in your day-to-day life. So you might have come across things like equity, fixed income, and FX in your day-to-day life, but you may not have heard about private equity, venture capitalist funds, hedge funds, and so on. So please go through each of these asset classes. Apart from that, I would say that please look at what are the risks, what are the advantages, what are the risks which are involved in each of these asset classes. Also see what are the biases. Typically, I would suggest you that please look at the biases which are existing for hedge funds. Probably I cannot cover most of the things in a single session, so I'm just touching upon things. So the revision part has to be done by you. Next is, I would want to touch upon derivatives. Derivatives, most of the questions are going to be quantitative, in nature. So please be aware with what is the risk, or what is the, let's say, the payoff for a call option, what is the payoff for a put option, what is the difference between futures and forwards, what is a swap, how can I value a swap, then probably I can say that what is the difference between a FRA and a normal swap, and then I should also understand what is the upper bound and the lower bound for each of the call and the put options. Please remember the put call parity. The put call parity which we have looked at is for European options. European options differ from American options. American options can be exercised at any point of time, whereas European options can only be exercised at maturity. This means that at any point of time, American options will always be more valuable than the European options. So when I am referring to derivatives, you should remember all the formulae, because derivatives will be more over formula based straight away questions. Next is, please explain contango and backwardation. So if the futures price is greater than the spot price, that means if your market is said to be at a premium, when your futures is greater than the spot price, this phenomenon is referred to as contango. Similarly, if the futures price were to be less than the spot price, so if my futures price is going to be less than the spot price, that means that market is in a discount phase. What do I mean by discount phase? That means that I am expecting that the value of the stock or the value of the underlying is likely to fall in the future. Then such a phenomenon is referred to as backwardation. Next, I would just want to touch upon is call option and put option. So basically, what is a call option? It is nothing but a right to purchase an asset at a pre-specified price in the future, which is nothing but referred to as the strike price. Please remember the payoff for a call option. So I'm just going to look at the payoff of call and put options. So in case of call options, I'm just drawing the payoffs. For a call option, the payoff is going to be something like this. So this is my strike. Now, usually the payoff is going to be somewhat negative below the strike. So this is nothing but the upfront premium which the buyer has paid to the seller. So this is nothing but the call option premium. If I were to assume that there is no option premium, then my payoff would look like something like this. Similarly, for a put option, the payoff would be something like this, which means that below a certain strike or below a certain spot value, I will have profits. Now this is to refer with buying call options and buying put options. Similarly, I could have something like where I would be selling call options. So if I'm going short on call options, then the payoff is going to be the inverse of this. So this is for buy side of call options. The short of call options, I will have a payoff which is mirror image of this. So it will go something like this. Similarly, for selling of put options, the payoff will be a mirror image of something like this. So please understand the payoffs for each of the options. With this, I would want to come to the end of this seminar. So due to having mixed reviews on this initiative, we would like you to give us a feedback, and we would like you to suggest that if should we have such initiatives in the future, and if this type of an initiative was helpful to you. So please take the feedback or the review on the link which we have shared to you. So the feedback or the review has to be given on the link which I am just sharing across. In case you have got any other queries, please get to us at yashu@enev.com. At the same time, we are leasing out the mind maps at a heavy discounted price. So it's like a one-day revision which we can do using the mind maps. So for that as well, please contact us at yashu@enev.com. In case you have got any doubts with regards to this webinar or with regards to any of the concepts, and if you feel that we have not covered any concept, or if you feel that there are certain examples which you are not able to solve, please feel free to mail it across to us at yashu@enim.com.